Have you ever stopped to think how a massive energy company, I mean a really big one, actually manages everything? Juggling traditional oil and gas with all this new renewable stuff, especially now with the global landscape being so, well, volatile. It looks complicated from the outside, and honestly, it is. So today, we're going deep into Enbridge Inc. That's ENB on both the TSX and NYSE. We're going to unpack their second quarter results for 2025, look at their strategy. Our sources are mainly their latest news release and regulatory filings. And our mission really is to cut through the jargon, the big numbers, and give you the clearest insights. How is this major North American player actually doing? What challenges are they hitting? And what does it all mean for energy's future? Maybe connect a few dots. Okay, so let's jump in. Enbridge's CEO, Greg Abel, keeps talking about an all-the-above approach to energy investment. What does that actually mean for a company like Enbridge? There are natural gas, oil, renewables. How does that translate on the ground in their results?
Well, it's interesting because the results really show it's not just talk, it seems baked into their strategy and their performance. They reported a record second quarter adjusted EBITDA, $4.6 billion.
$4.6 billion. Wow.
How does that compare?
That's up 7% from the same time last year, Q2 2024, which was $4.3 billion. It's pretty significant. And it suggests really strong operational efficiency across that whole diverse portfolio you mentioned. They seem good at running what they have while building new stuff.
Right. And predictability seems to be a huge theme for them, too. The CEO mentioned high utilization and low-risk commercial frameworks. Even while acknowledging, all the geopolitical and economic bumps out there, how do they pull off that stability?
That's a really critical point. Delivering that kind of
Exactly. And that speaks volumes about their business model. A lot of it is long-term contracts, fee-based services. It insulates them somewhat from, the day-to-day commodity price swings.
Okay, let's get into the nitty-gritty of the financials then, because that's where you really see the health of the business, right? Beyond that record EBITDA number, what else should we be looking at to really understand how they did?
Yeah, good question. If we want the bigger picture, their GAAP earnings, the standard accounting earnings for common shareholders, jumped quite a bit. Came in at $2.2 billion, or $1 per share. That's up from $1.8 billion, or 0.86 last year.
Okay, so a solid increase there too.
Definitely. And adjusted earnings, which smooths out some items, also saw a healthy bump to $1.4 billion, or 0.65 per share. Cash from operations looks strong too, $3.2 billion, up from $2.8 billion.
So cash flow's up.
Well, operating cash flow, yes. But it's worth noting that distributable cash flow, the DCF number we mentioned earlier, is actually pretty similar to last year, about $2.9 billion.
Why is that if operating cash was up?
It seems to be mainly down to higher financing costs, interest rates, and also spending more on maintenance capital, partly because they've brought new assets online that need upkeep. It's kind of that classic growth company thing, right? Investing heavily can absorb some of that immediate cash flow.
Right. You spend money to make money, essentially.
Yeah.
So what does all this mean for their financial flexibility? Keeping a strong balance sheet must be vital for these huge infrastructure plays.
Absolutely crucial. And that brings us to the debt question. How are they managing it with all this expansion? Well, they ended the quarter with a debt-to-EBITDA ratio of 4.7 times.
4.7x. Is that high-low average?
They state it's below the midpoint of their target range. So basically, they're saying they're comfortable, not over-leveraged. It suggests they have, significant financial flexibility, enough horsepower to fund future projects without stressing the balance sheet.
Okay, that makes sense. Now, they announced a whole bunch of new projects, closed some deals. Let's talk about those specific investments, especially how they show that balance. You talk about traditional energy versus renewables and lower carbon stuff.
Yeah, and they gave some really concrete examples, which is helpful. Like, they sanctioned the Clear Fork Solar project.
Clear Fork Solar?
It's a big one. 600 megawatts, costing about US $0.9 billion.
Wow.
And importantly, it's not just speculative. It's got a long-term offtake agreement with Meta. So Meta is committed to buying the power for its data centers.
Oh, so that de-risks it quite a bit.
Exactly. It's expected online in 2027, and it really highlights that huge demand from big corporations for large-scale, reliable, renewable power.
That is a big renewables play. But like you said, they're still investing heavily in natural gas too, right? That's still core.
Oh, absolutely. They haven't abandoned their roots at all. On the gas side, they sanctioned a U.S. $100 million expansion on the Texas Eastern Transmission System, Line 31, that's aimed at serving growing industrial and power demand down there, expected by 2028.
Right.
And they also upsized the Traverse pipeline. That's going from 1.75 up to 2.5 billion cubic feet per day. Again, strong market demand. That one offers bi-directional service in the U.S. Gulf Coast, planned for 2027.
So more capacity in key areas.
Right. And up in Western Canada, another one, a $0.3 billion expansion of the Aitken Creek gas storage facility. That adds 40 billion cubic feet of storage. They describe that as providing critical flexibility for Canada's LNG export chain,
Oh.
also expected by 2028.
And that Indigenous Alliance investment in the West Coast pipeline system, that also stood out to me. Seems like more than just dollars and cents.
Yeah, that was a really significant closing, I think. It's a 12.5% equity stake in the West Coast system. Bought by the Stoneless-Sec 8 Indigenous Alliance, that's a consortium of 38 First Nations groups. The deal brought Enbridge proceeds of $700 million.
38 groups, wow.
It really reflects this wider and frankly crucial trend, greater Indigenous involvement, actual ownership in major energy projects. It's about partnership, shared benefits, a long-term stake.
So you add up all these projects, solar, gas transmission, storage, partnerships. What does this pile of investments signal about their future growth?
Well, their secured growth backlog, the stuff they're definitely building, is now over $30 billion. That's across all four businesses: gas, liquids, power.
30 billion.
Secured.
Right. And beyond that, they say they're pursuing a longer-term opportunity set worth potentially $50 billion. So the strategy is clear. Keep investing across the board, reflecting that confidence in diversified energy demand for the long haul. Big signal on future capital deployment.
Of course, it's never just about building things and making money. These big energy companies are always dealing with legal stuff, regulations. Let's talk about the Line 5 pipeline situation in Michigan. That seems incredibly complex, lots of moving parts. It really is, and it's a fascinating window into the challenges of operating critical infrastructure today. You've got this multi-layered legal fight. So Michigan's Attorney General sued to shut down Line 5 in the Straits of Mackinac. The Federal Appeals Court, the Sixth Circuit, initially said the case should be in state court.
Yeah.
But Enbridge appealed that decision to the U.S. Supreme Court. And in June, the Supreme Court actually agreed to hear the case.
The Supreme Court is taking it. That sounds major.
It is. They'll basically decide whether state or federal courts have jurisdiction over these kinds of interstate pipeline disputes. It could set a big precedent nationally. They're expected to hear arguments late this year, maybe a decision first half of 2026.
And meanwhile,
Well, there's also Enbridge's own lawsuit against Michigan officials. The Sixth Circuit ruled on that too and basically sent it back to the lower district court. So lots of legal maneuvering.
right, lots of lawyers busy. But the pipeline itself is still running for now.
Correct. It continues to operate. And that's similar to the Dakota Access Pipeline, DAPL.
What's the latest there? How do these legal things impact the day-to-day?
For DAPL, they're waiting on a final environmental impact statement, the EIS. That's expected sometime in 2025. Crucially, the pipeline stays operational during this whole EIS process.
Okay.
There was a new lawsuit from the Standing Rock Sioux tribe trying to get it shut down permanently, but the district court dismissed that, though the tribe is appealing that dismissal. So again, legal battles continue, but the infrastructure keeps flowing unless or until a court orders it stopped. It underscores the operational continuity despite the headlines.
Beyond those specific pipeline fights, there are always broader regulatory things happening, especially with their gas distribution utilities, right? It's a different kind of regulatory challenge.
Absolutely. Rate cases are a constant feature there. In Ontario, they reached a settlement on what's called rebasing phase 2 for their gas distribution utility.
Rebasing.
Yeah, it basically means resetting the baseline for the rates they can charge customers to cover their costs and earn a regulated return on their investment. And in Ohio, the Public Utilities Commission issued its decision on the Enbridge Gas Ohio rate case. The outcome was mostly in line with what they expected, kept their allowed return on equity at 9.8%, increased the equity thickness to 51.9%.
Equity thickness, meaning more of their own capital versus debt.
Exactly. Signals financial stability to regulators. But the Ohio decision also included a $330 million impairment charge.
Ouch. What was that for?
Related to pensions and some other cost disallowances, Enbridge Gas Ohio is actually asking for a rehearing on parts of that decision.
So Not entirely happy with that outcome.
Seems not entirely. And they've got new rate cases going on in Utah and North Carolina, too, with new rates expected for 2026. It just highlights that constant, detailed regulatory engagement you need in the utility business. It's always ongoing.
Okay, let's pivot back to operations for a minute.
Hmm.
The report breaks down performance by business segment. What does that tell us? Does it give a more granular view of where the strengths and weaknesses were?
It absolutely does. And it shows where the different parts of that diversified model are contributing. For example, gas transmission. Their adjusted EBITDA there was up $302 million compared to Q2 last year.
What drove that?
Things like favorable contracting, winning those rate case settlements we just talked about, and contributions from recent acquisitions like the Whistler Parent JV gas distribution and storage also saw a big jump, up $273 million.
And that was.
Largely from having the full contribution of those US gas utilities they bought recently, plus higher distribution margins and even just colder weather in Ontario boosting demand. Simple stuff sometimes.
Right, but I assume not everything was up. You mentioned diversity, which usually means some parts zig while others zag.
That's exactly right. It wasn't all positive across the board, which again shows the portfolio effect. Liquids Pipelines adjusted EBITDA actually decreased by $120 million.
Why the drop there?
Primarily lower volumes on some pipelines. Specifically, they mentioned some Gulf Coast and Mid-Continent systems, and also the Bakken system, so less oil flowing through certain pipes. And renewable power generation was also down slightly, about $27 million.
Really? Despite the big solar announcement.
Yeah, the decrease was mostly due to lower contributions from their European offshore wind farms in this specific quarter. Maybe wind speeds or maintenance, the report didn't specify exactly why. But these details really help you understand the different dynamics at play within the larger company, the headwinds and tailwinds in each segment.
Definitely. And just one more thing on the finance side. How are they managing funding for all these projects? You mentioned the debt ratio, but what about actual borrowing?
Right. How do they keep the cash flowing for that $30 billion backlog? Well, they were active in the debt markets. In June, the main Enbridge company issued US $2.25 billion in medium-term notes, just for general corporate purposes. And Enbridge Gas Ohio issued $500 million in senior notes, mainly to refinance debt that was coming due.
Okay, so raising new cash and managing existing debt.
Exactly. And they also renewed a huge chunk of their credit facilities, basically, their corporate credit cards. They renewed about $8.8 billion worth, pushing the expiry date out to July 2027, and another $7.8 billion in 5-year facilities, extending those out to July 2030.
So securing their liquidity lines for the medium term.
Precisely. It all underscores that focus on maintaining a strong balance sheet, keeping plenty of cash accessible to fund those ambitious growth plans we talked about.
Okay, so we've really covered a lot of ground here on Enbridge's Q2 2025. From that record EBITDA and the sort of two-pronged growth in renewables and natural gas, to navigating those really complex legal and regulatory hurdles like Line 5, and also just managing the sheer scale of their operations across different segments. It's definitely a complex picture. And as you think about this, all of the above strategy that Enbridge is pursuing, consider this. Its success really depends on this continuous intricate dance, doesn't it? Between traditional fossil fuels, which still dominate the energy mix, and these emerging renewable technologies. And all of it happens under intense scrutiny from regulators, the public, everyone. So how might the ongoing energy transition start to change what predictable returns even means for a company like Enbridge? And looking ahead, what kind of unexpected opportunities, or maybe even unexpected challenges, could pop up from that fundamental shift? Something to mull over. Keep exploring.